made it to our webinar. As I was saying, we had, as from the opening of the webinar, we had 215 people registered. I hope that most of the people are going to make it to the webinar. For those of you who cannot make it or need to drop off earlier, or want to have a look at our previous webinars, you can check out our YouTube channel. You just type in YouTube Aurifer Middle East Tax Consultancy, DMCC. For those of you who have not registered to our newsletter, our monthly newsletter, I encourage you to do so. We are the only tax firm in the GCC that publishes a monthly newsletter with all updates from the GCC. And obviously, for those of you who do not follow our, by now, famous LinkedIn page, either the company page or my personal page, please do so, because there's a lot of information posted on a daily basis. This webinar today, in the coming hour or so, we're going to be talking for a bit longer than 1 hour. We're going to run through some of the updates on the tax authority side in the last 3 months. The agenda, you can see it in front of you. The agenda and the topics. So the aim really of our quarterly update seminars, which have proven to be very popular, is to try and package the most relevant and most recent tax developments for anyone who is an in-house practitioner, or also, I know that some of our competitors have logged in as well, for the general public, whether you're finance, legal, or tax in-house and looking after taxation in the GCC. Then we try and save you some time so that you don't have to go through all of the different newsletters, all of the different news flashes and whatnot. We try and package everything for you. So you can see in front of you the topics that we will be covering today. We will have a Q&A as well at the end. So we'll give the opportunity to everyone to ask questions as well. So feel free to do so. But in the interest of time, we're going to keep them until the end. What you see in front of you is the agenda of the topics that we will be covering today. We will be spending the bulk of our time on number 1 and number 2, and especially on number 1. We've tried and make the topics as digestible as possible and as concrete and practical as possible. So hopefully we will have succeeded in that. So without further ado, I suggest that we head into the first topic already. And the first topic, there's a number of important elements to mention, especially for this region, for the GCC region. We are expecting in the next year and a half the most important changes to the international tax system since the Second World War. And in order to understand that, we first need to talk a bit about the background and how these changes came about. What was the reason for it? What was the driver behind some of the proposed changes? And I think the best way to do so is to present you with a case study. And this case study is not meant to focus necessarily on one company in specific, but it is helpful because in this case, we could find back very concrete numbers. So the case study evolves around a company called Apple Sales International, which is a company incorporated in Ireland. Now, the particularity, obviously, everyone is familiar with Apple, is that Apple makes a lot of online sales, whether it's goods or whether it's simply purchases through the App Store. Now, Apple in Ireland benefits from a very attractive tax regime, not just because there's a very low statutory corporate tax rate of 12.5%, but also simply because it was benefiting from a very interesting ruling that was granted by the Irish Tax Authority. And it led Apple to try and defend itself towards the wider public, not just Apple, other companies as well, publishing what is their so-called global effective tax rate. So what is the taxes paid on all of the revenue which has been realized by Apple? And you can see a statement by Apple in November 2017 saying, our global effective tax rate is 24.6%. And over the last few years, we paid $1.5 billion in taxes. Now, the European Commission was not in favor of the tax ruling that Apple Sales International was benefiting from in Ireland, and in the proceedings against the state of Ireland, you could see some of the claims made by the Commission, for example, that the effective tax rate of Apple Sales International in 2014 was, and that number is correct in front of you, 0.005%. In other words, it was extremely low. Going back to numbers from 2011, in 2011, Apple Sales International made 22 billion euros in profits and paid only 10 million euros in corporate income tax. As I said, it's only a case study, and there's many other cases as well, and especially evolving around the GAFA companies, the GAFA, Google, Amazon, Facebook, and Apple, but also other companies as well. What was the issue is in the design of international tax, we always have two main concepts which are very important. On the one hand, we've got residency. On the other hand, we have the source of the income. Now, because of the fact that these, some of the principles on an international level are not aligned, there were certain gaps in the international tax framework. Obviously, when you see these numbers, it looks very extreme, especially to a person who might be paying personal income tax at a rate of anywhere between 30 and 50%. So the case study is there to show that there were extreme examples of allegations of profit shifting. And so what the whole driver was behind the current changes, but also some of the changes in the last few years, was a fairer taxation, preventing the shifting of profit, in this case, to Ireland, and more equity in paying taxes. Now, what was then developed as a reaction to that, already a number of years back, there was the BEPS project, which was developed, base erosion and profit shifting, specifically targeted towards these types of situations. Now, what happened initially is BEPS was something that was developed within the OECD, and the OECD has roughly 30 members. Now, you can only do so much with 30 members. So there was a structure put in place called the Inclusive Framework, which includes many more countries. And that Inclusive Framework had agreed to implement a number of changes to the international tax system. Part of those were part of the BEPS project. But recently, because of the COVID-19 pandemic and the economic impacts thereof, and therefore the additional fiscal pressure on a lot of the states, what happened was discussions around what we call the two-pillar approach to ensure a fair taxation. They have accelerated very significantly. And that two-pillar approach is merely, the word pillar doesn't really mean anything. You could call it project or file or whatever. It just means that the 137 members of the Inclusive Framework, they are working around two main concepts. And the important thing is that out of the GCC countries, 5 out of the 6 are part of the Inclusive Framework. So the only one who's not part of the inclusive framework is Kuwait. The solution proposed was therefore twofold, and it's those solutions that we're going to discuss today, and we're going to be having a very significant impact on the international tax system going forward. Pillar 1, and we'll discuss in a bit more in detail in a bit, talks about a new taxing rule determining nexus, so where to tax in a different way and how to allocate profit. Pillar 2, the most visible and maybe easier concept to understand as well in terms of its implementation, talks about the implementation of a global minimum tax. Now, you might say this all sounds a bit vague and whatnot. As we will show in a second, there is already a political agreement on the headline principles. What is going to be coming next month is a more detailed plan agreed between the inclusive framework members and a more work conducted on some of the remaining issues. The important thing is that the deadlines, the timelines have been agreed to. In 2022, so that's less than 3.5 months away, we will have legislation issued implementing Pillar 1 and Pillar 2. And the effective implementation of those two pillars is going to happen in 2023. So this means also that we need to start preparing for those events. Now, if you look at a timeline, and our timeline starts very recently in June 2021, there was a G7 press release where all of the leaders of the G7, the finance ministers, have agreed on the adoption of the two-pillar approach and will be implementing it. The reason why this gained momentum is, as I said, because of the COVID-19 pandemic. A lot of states need additional fiscal revenues, but in addition to that, the US was prepared to put its weight behind this, and this has really accelerated the adoption. Subsequently, in July, so that means 2 months back, the inclusive framework members, if you count the inclusive framework members plus the G20, we're at around 140 countries. They published a more detailed statement stating on which principles they have agreed already. Some countries that had not stated that they will be adopting it are, amongst others, Ireland and Hungary for their own specific reasons. And so in next month, so in a few weeks, we will have a final agreement and a more detailed plan. And then, as mentioned, in 2022, we will have legislation released, likely what is called a multilateral instrument for Amount A. We're going to discuss that in a second, and a law and or draft template law for Pillar 2, within an entry into effect of Pillar 1 and Pillar 2 in 2023. Now, very specifically, what do these entail, these two pillars? Bear with me a bit, because Pillar 1 is perhaps a bit more difficult from a conceptual point of view. Pillar 2 is a bit easier to understand. Pillar 1, you need to somehow think of the example again that we gave, which was a country hosts a company that is a global company, a very profitable company that has users in a number of other countries, but does not pay taxation in that country. So what Amount A under Pillar 1 aims to achieve is to say, we are going to shift the profits away from the country in which that company is residing to the market or user jurisdiction. In other words, in our use case or in our business case, it is no longer Ireland that has the right to tax some of the revenue, it goes to the country where the user is located. So that's amount A. We are talking about the design of a new rule to tax. As I said, the international tax framework is largely based around residency and source. This is a new type of sourcing rule. And in addition to that, we would also implement something called amount B. So we've got amount A and B under Pillar 1. And amount B grants a fixed rate of a return on marketing and distribution activities in the country where the company that conducts those marketing and distribution activities is established. Now, this needs to be done at arm's length and is going to be implemented simultaneously with the implementation of amount A. Relatively logical, based on transfer pricing principles. In addition to that, you might already have guessed that multiple countries may be fighting for the same bone, effectively, the taxing right. Depending on how we determine the criteria, there might be multiple countries claiming the right to tax. So therefore, under Pillar 1, we will also have effective dispute prevention and resolution mechanisms. And importantly, there's been an agreement to exclude 2 sectors from Pillar 1. On the one hand, we're talking about extractive industries. So it's only for the country where the extraction happens to tax the revenue. And the regulated financial sector is also only taxed in a country where it is regulated. So those are important exclusions. And if you look at the political agreement, what are the companies in scope? They are multinational companies, and those multinational companies need to have a global turnover in excess of 20 billion euros. Before you disconnect and say this might not be for us, the intention is that in a number of years, that threshold is dropped to 10 billion euros. And obviously there's going to be an evaluation as well of the regime and potential extension as well. Sorry, I lost the light there for a second. In addition to that, this is for companies that have a profitability in excess of 10%. So profit before tax in excess of 10%. Sorry for the little technical glitch. I'm hoping that our lights will hold. Such companies that are in scope, they need to determine and calculate amount A, and that amount A should be allocated to the market jurisdiction, i.e. the location where the users are located of the services of that company. Now, if in order to limit compliance costs, it's only in the situation where amount A is in excess of 1 million euros that effectively that company is going to have to pay that amount A in that market jurisdiction. If the users are in a small country with a GDP less than 40 billion euros, the threshold drops to 250,000 euros. So effectively, when we're talking about the compliance costs, it means that a business that is located in a certain country, but has users in a number of other countries, it means that that company has to register for corporate income tax purposes in those other countries in order to be able to declare and report amount A. Now, how much are we going to reallocate to the market jurisdiction? There also, we have a broad agreement. The final number needs to be settled upon, but any profit in excess of 10% of revenue, of that residual profit, 20 to 30% needs to be allocated to the market jurisdiction. To show you graphically how that looks like, you see on your right-hand side profits. The 10% routine profit is fine to be taxed in the country of residence. Anything beyond that is considered non-routine profits. And of that non-routine profits, there will be 20 to 30% allocated to the market jurisdiction. Now, when we say allocated using a revenue-based allocation key, those allocation keys, they are largely based on principles that we already see in for VAT purposes for telecoms, broadcasting, and electronically supplied services, i.e. we're going to look at where the IP address is, where the billing address is, where the advertising is watched as well. So all of those criteria will be taken into account. What this effectively means in the example that you see in front of you, we've got a multinational company headquartered in country X and has got customers in country Y and in country Z. Now, under normal circumstances, company H in country X is entitled to all profits. So that is what you see on the left-hand side of the table. You see the income of HCO is only taxable in country X. Whereas if we apply Pillar 1, and in our example, we've got a consolidated revenue of 30 billion euros and a profit before tax of 5 billion. And we've assumed, for the sake of the example, that what is to be allocated to the market jurisdiction. So what we look at is we take 10% of 30, which should give us the routine profit, which is 3 billion euros. Given the fact that we have a 5 billion profit, our residual profit is 5 minus 3 equals 2 billion euros. And then amount A, 20% of that residual profit times 2 means I've got 0.4 billion to be distributed in jurisdictions Y and Z. And then also, so Y and Z will have a taxing right created, and we then, it's then up to countries Y and Z to also determine at what rate they want to tax those that revenue. As for amount B is a bit more complicated in regards to the setup, because of the fact that there isn't a full political agreement yet on how high that should be, but the principle should be that distributors that make baseline marketing and distribution activities in the market jurisdiction should also have a at arm's length remuneration in that jurisdiction. So the aim really there is to allocate a fixed percentage to those distributors. There's talk about creating what is called a safe harbor. A safe harbor is a situation where a company can apply a principle, a lump sum principle, without this necessarily being the actual reality. And an important thing as well is, due to the application of these new taxing rules, all digital service taxes, which are currently applied in a number of countries such as France and Germany, that these would be removed. So you can see the incentive really from the US on this point. A lot of these digital companies were established in the US, and they were suffering from the application of these digital services taxes with different concepts, rates, and whatnot. So this facilitates, to a certain extent, the removal of these digital service taxes. Now, that is, as said, something that will be coming, Pillar 1. Now let's talk about Pillar 2. Pillar 2 is going to have a significantly higher impact on the GCC than Pillar 1. We will look at the impacts on the GCC in a second. Now, the idea behind Pillar 2 is that all internationally operating businesses, that they pay a minimum level of tax. And the scope of Pillar 2 is businesses with a global consolidated turnover in excess of 750 million euros. Now, again, before you switch off, as we will see in a bit, it will make sense for some of the states not just to implement Pillar 2, but to implement a corporate income tax across the board as well. The principle behind the adoption of this decision is that on a jurisdictional basis, i.e. in every country, there needs to be a 15% corporate income tax paid, effective tax rate. Now, how are we going to do that? There's a number of principles prescribed here, of which the most easy one to comprehend is if a subsidiary's income is not taxed at a sufficient rate, then we will include it in the income of the parent. And that might be reminiscent for some of you of CFC rules. We'll show in a second how those apply as well. Now, if that wouldn't work, there's also a rule which says that if there's any expenses paid to non-compliant jurisdictions, i.e. jurisdictions that do not have the minimum 15% corporate income tax. Thank you to our technical staff for fixing the light. Then we will be rejecting the deduction of those expenses. There's two more rules, but I'll spare you the technicalities for this. The main headline that you need to understand is that countries have agreed that on a global basis, international companies, that they need to be taxed at a minimum at 15% per jurisdiction. Now, there's going to be a carve out for businesses that have tangible assets on their balance sheet and payroll. 7.5% of that can be carved out of the calculation. So that makes the calculation a bit more complicated. Now, what is going to happen as from October is on an OECD level and inclusive framework level, standard model legislation will be developed, as well as documentation and guidance and so forth. We will show you now with an example what this entails, because I think an example is a bit easier to comprehend. In our example, we've got a parent in country A, we've got a subsidiary in country B, a branch in country C, and a subsidiary also in country D. Now, if we look at, if we assume that in countries B, C, and D, the income of the different legal entities is 100, and then we look at the effective tax rate, we assume that in country B, the income of 100 is taxed at 16%. That means that Pillar 2 has no effect on country B. Country C, there is a branch of the parent which is incorporated in country A, and that branch pays only 10% corporate income tax. Now, the important thing here is because branches are part of the same legal entity as their parent, very often in countries there is an exemption in the country of the parent of the income of the branch. We cannot use the income inclusion rule, so therefore there is something called the switch over rule when there is a branch. And so the branch, which is paying currently 10% corporate income tax, that will create an additional tax liability for the parent of 5. The reason being that in country C, there is insufficiently tax paid. So there's only 10% tax paid instead of 15. So therefore, we need to have an additional 5 paid in the country of the parent. Finally, subsidiary X in country D pays 0% corporate income tax. That's similar to maybe in the region UAE and Bahrain. As a result of the fact that it doesn't meet the 15% effective tax rate in the country of the parent, there's going to have to be 15 as a tax additionally paid to the tax authority in that jurisdiction. I'm going to try and adjust the light here a tiny bit without hopefully losing it. Perfect. All right. Now, if we look at the impact on the GCC of these changes, these impacts might be very important. On the left-hand side, you see the 6 GCC countries, and in the middle column, you see the current status. We always say the UAE and Bahrain are not really tax-free countries because some businesses do pay corporate income tax, but overall, the grand majority of the companies do not pay corporate income tax. The case of KSA is a bit special because it has a dual system with the payment of corporate income tax and zakat. Qatar, there is corporate income tax at a rate of 10% and exemptions for GCC nationals. The same thing for Kuwait, but with a different rate. And Oman does not make any difference between GCC nationals and non-GCC nationals and taxes profits at 15%. Now you can immediately see that some of these systems will not meet the 15% effective tax rate. What you see in front of you in the middle are statutory tax rates. What we expect, therefore, for UAE and Bahrain is that the UAE and Bahrain are going to have to take a position vis-a-vis the implementation of Pillar 2. Both countries, and all of the GCC countries except for Kuwait, have committed to implementing Pillar 1 and Pillar 2. When we talk about the impact of Pillar 2, there's several options for the UAE and Bahrain. One option is to not do anything, but that means that effectively they agree that income which is recorded in the UAE is going to be taxed in other countries. Therefore, more reasonable and more likely is that those countries will either implement corporate income tax rates on a limited basis, i.e. only for the scope of Pillar 2, or on a broad basis to not create any domestic differences between businesses. For KSA, the local 2.5% of zakat does not meet the effective tax rate of 15%. So therefore, it is likely that the plans for the removal of zakat are going to be accelerated and that we will have one single corporate income tax system in Saudi with a potential amendment of the CIT rate. In Qatar and in Kuwait, we expect the exemptions for locals to be removed, at least in situations where they are internationally active. And in the case of Qatar, a potential increase in the rate. In Oman, although the statutory rate is 15%, that doesn't necessarily mean that the effective tax rate is also 15%. We expect no amendments or very little amendments to the legislative framework. Now, the two countries which are mostly affected by these changes would be the UAE and Bahrain. Now, if we look at Pillar 1, Pillar 1 is going to be easy for the UAE and Bahrain to implement because effectively they'd be taxing very profitable global companies who might currently not be paying any income tax in the UAE anyways. So this is a fairly easy win for the UAE and for Bahrain to implement this new taxing rule and tax these businesses in the UAE. However, a few observations there. One is that the UAE and Bahrain have a limited internal market. And in terms of the baseline remuneration for distribution businesses, this will also largely depend on the functions and the profiles of these businesses. For sure, the UAE and Bahrain will adopt dispute resolution clauses. And if they effectively foresee the taxation of amount A, it means that in comparison to what is currently the case where they are not taxing it, they will have a net gain in tax revenue. Easy to collect, easy to say that this is based on international developments. So it is very, very likely that this is going to go ahead. Now for Pillar 2, the situation is a bit more complex. As said, the simplified policy options of the UAE is to either do nothing, have a minimum approach, or adopt CIT at a rate of 15%. The tax revenue effects of the first option is neutral. The UAE or Bahrain would not be collecting more taxes because of it. In a minimum approach, i.e. taxing only businesses with a global consolidated turnover in excess of 750 million euros, the tax revenue would be positive. Remind you again that it doesn't mean that you need to have revenue of 750 million euros in the UAE. It is a global threshold. And obviously, in the event that UAE would adopt corporate income tax at the rate of 15% across the board, then the effect on the tax revenue will be very positive. Few important points is that there's political sticking points in the UAE, notably the tax exemptions given to free zones and the distribution of the federal income between the Emirates. From a broader perspective, these will have substantial impacts on structure of the economy. A number of businesses are established in the UAE and Bahrain because of the fact that it's a no tax jurisdiction. The UAE will continue to be a regional hub because of the fact that most countries around the world will implement this at the same time. There will be a level playing field for countries on this, so that doesn't change the fact that the UAE will continue to be a regional hub. But as most of you will know, it is undergoing a lot of challenges from KSA in regard to that position. Obviously, there's going to be a substantial administrative impact in regard to the cost of filing for the businesses that are in scope. And it follows a bit the broader evolutions in UAE and Bahrain. For the last few years, we've seen the introduction of excise tax, VAT, economic substance regulations, stricter FATCA and CRS reporting, UBO reporting. The implementation of Pillar 1 and Pillar 2 is not going to impact any of those regulations. They will remain in place. The only one that might be removed is the economic substance regulations, because if we have corporate income tax at a sufficiently high enough rate, then there is no need anymore to demonstrate substance. What is important for businesses as well right now is that timeline is there and has been committed to. There was a press release as well 2 months back from the UAE Ministry of Finance saying that they confirmed that they are committed to the implementation of the 2 pillars. That means effectively that in the UAE and Bahrain, as well as in the other GCC countries which are part of the inclusive framework, we are expecting legislation next year, early next year, and then an effective collection of the taxes as from 2023. What that means is if you're currently stepping into a long-term joint venture or infrastructure project or the like, the impact of the implementation of Pillar 1 and Pillar 2 needs to be analyzed. In the same way, a number of impact assessments need to be conducted, because there will not just be a financial impact, but also an admin impact of the implementation of these pillars. It's not all bad news. I will demonstrate with a few examples in a second that the implementation of Pillar 2 in a number of situations, and those are definitely not extraordinary situations, they are very common. The overall impact, the effective tax rate of the group, is not going to be adversely affected. We'll explain that to you in a bit. Value chains are going to be impacted for sure. And for some of the GCC unicorns, which are coincidentally startups which grew out of the UAE, their tax position is going to be impacted in a negative way. Why? Because of the implementation of Amount A, they will have to be paying corporate income tax in some of the market jurisdictions where they are active. Now, very important, specifically for tax havens such as the UAE and Bahrain. The UAE and Bahrain, they undergo a number of punitive measures currently, whether it is the monitoring of payments with these tax havens and the exchange of information with them, denying the application of participation exemptions, application of so-called CFC rules. We'll explain in a second what those are. Rejections of any payments made to tax havens from a tax point of view. The rejection of that means that you cannot deduct it from a corporate income tax point of view, and substance requirements in the tax haven jurisdiction. There's a number of other measures as well, which I am sparing you right now. But the important thing is if there is an implementation of Pillar 2, then these punitive measures are going to be removed, and those can have an overall positive effect. Now, what I took as an example is a country with which the GCC conducts a fair amount of business, the UK. The UK would have, amongst others, 2 rules which would be impacted by the fact that the UAE would be implementing corporate income tax at a rate of 15%, or Bahrain for that matter. The 2 rules are, on the one hand, the CFC rules, and on the other hand, the participation exemption. But the CFC rule says that if a UK parent has a subsidiary in a country where there is a lower level of taxation, lower than 75% of what would be the UK tax on the same profit, we will include the income at the UK level and tax it at the statutory CIT rate in the UK. Okay, I'm simplifying the regime for the purposes of giving the example, but you will see in a second what the effects of this are. The other one is called a participation exemption, which is very important exemption for holding companies. Holding companies that benefit from the participation exemption can exempt the dividends which they receive from abroad from corporate income tax in the country where they are incorporated. Now, in the UK, as with a lot of other countries, when those dividends are paid from a tax haven, then the dividend exemption is generally not granted. The reason why it is important to look at these things is in situations where the corporate income tax rate in the country of the parent is higher than the one that would be implemented as a result of Pillar 2, the overall tax effect, the overall effective tax rate is going to be lower after the implementation of a corporate income tax. So in front of you, you will see 2 situations. On the one hand, you have a situation in which the CFC rules apply, and on the other hand, you see a situation where the UAE would implement corporate income tax. Now, the statutory rate in the UK is 19%. If we assume that the income of the parent and subsidiary is 10, then what we have on the left-hand side is 10, which is taxed in the UK at 19%. And on the account of the fact that the UAE subsidiary does not pay any income tax in the UAE, we will be adding the income of the UAE subsidiary to the UK parent. So in other words, 10 plus 10 is 20 times 19%, means we need to pay 3.8 million euros income tax, or the equivalent in pounds. On your right-hand side, you see the situation where the UAE would have implemented a corporate income tax rate of 15%. 15% would effectively comply with the CFC rules in the UK, and therefore we do not have an additional CFC charge, an additional income tax to be paid in the UK. That means that I can have my 10 tax at 15 in the UAE and my 10 tax in the UK at 19%. That means that I've got overall, for the 2 entities combined, a tax burden of 3.4 million So that means that if the UAE implements corporate income tax at 15%, the overall effect is more beneficial as opposed to the current situation. Another example is the participation exemption. In the situation where the participation exemption is disallowed and there's a distribution of dividends from the UAE of 10, due to the fact that the participation exemption is disallowed, these dividends are taxed on the level of the UK parent, 19%, so therefore 1.9 needs to be paid in taxes. Now, in the situation where the UAE imposes a corporate income tax of 15%, because of the fact that there is corporate income tax, the participation exemption applies. So we do not have the 19% on 10, so we're not 1.9. And if we calculate it back, in order to be distributing 10 out of income of 100 at a 15% CIT rate, the CIT that we will be paying is 1.765. Again, it is a situation in which if the UAE implements corporate income tax at a rate which is lower than the country of the parent, then the situation is more beneficial than before the introduction of the corporate income tax. Now, what are the next steps to be on the lookout for in the next few weeks and months? Very soon, in a matter of 2 to 3 weeks, we will see statements made by the Inclusive Framework members, so in October 2021, where more detail will be released in regard to the implementation. When I say more detail, as I might have demonstrated until now, there is agreement on the headline principles already. So there's not, the discussions, they largely evolve around details, largely technical details, but no longer about the principles. The principles have been adopted, and the countries which are part of the inclusive framework, the OECD and the G20 countries, they are going to go ahead with this. So what we will see is domestic legislation for Amount A, the nexus rules, an MLI for Pillar 1 to avoid disputes, and more work to be done on Amount B over the course of 2022. A removal, as we said, of the digital service taxes, and domestic legislation to be issued for Pillar 2 in 2022. How do you prepare for this right now as a business? We already made some suggestions in regards to the impact. Now, for those of you businesses that file a country-by-country report, today you can already make a quick calculation of what is the effective tax rate per jurisdiction and what would be the top-up tax that you need to pay, because that is something that is going to go ahead anyways at this point. So that it's something that you can already analyze. The other thing to take into account is what different jurisdictions will be doing and adopting. So, for example, the table that we showed on the GCC, there's different possibilities, and I think the ones that are going to undergo the most important changes, as we've highlighted, will be the UAE and Bahrain. Importantly, I would map the measures which are currently taken against tax havens and which are impacting your business today, and how these might potentially be removed, and obviously calculate the financial impact overall for the group of the implementation of Pillar 1 and Pillar 2. We did a little poll online that we started yesterday. The question that we asked was what the policy option will be that the UAE will choose. The UAE and Bahrain. There were 3 options. One is do nothing. That means accepting the principles of Pillar 1 and Pillar 2 and not adopt any corporate income tax. The other option was implement a limited corporate income tax, and the majority of people have indicated that their expectation is that the UAE will be adopting a limited corporate income tax only. Unfortunately, we're unable to ask more detailed questions in such a poll, such as, does this mean only for the companies that are in scope of Pillar 2? Or does this mean that people think that it will be applied across the board with exceptions for the free zones? And then around 1/3 of the respondents said that they expect a full corporate income tax to be implemented. So for those of you who might be skeptical and be in the 15%, you can see that the grand majority of the people that we polled does expect that there are going to be changes to the tax framework in the UAE and Bahrain over the next few months. Again, here, for those of you who do not follow us on LinkedIn, please do so. You can also register for our newsletter and follow us on YouTube as well. That concludes maybe a more heavy topic of Pillar 1 and Pillar 2. You will be hearing quite a lot about this in the next few months, and I would definitely suggest that all of you monitor the international press, but also obviously our LinkedIn page to see the latest updates on this, because at some point it's going to come and then we won't have a lot of time anymore to prepare. Now the next topic, which is topic number 2 on the agenda, I said we've got roughly 6 topics. The first 2 are going to take the most time and the most of our time together. KSA e-invoicing. So e-invoicing is something which is not new, which has been favored by the European Commission for years already, and the main arguments being administrative simplification and whatnot. Now, KSA is the first GCC country to implement mandatory e-invoicing, and it does so with a number of objectives. One is to reduce VAT fraud. So in other words, close the gap between what the tax authority should be collecting and what it is collecting. Facilitate VAT reporting as well. If there are automatically generated invoices and the reports, then businesses will spend much less time on preparing VAT returns. And ZATCA proposes to do so in a 2-phased approach. So the first phase is going to come very soon. As from the 4th of December of this year, all businesses need to adopt the principles of the generation phase. After the generation phase, we'll get into that in a second, we will have the integration phase, where the software needs to link in with the tax authority, and the tax authority will adopt something called a hard clearance model, which means that your invoices need to be approved by the tax authority before they are sent to the customer. What this will make available is a large amount of data for ZATCA to compare with income statements, to compare with GOSI data, and to compare with payments made in Saudi and from Saudi to abroad. E-invoicing has really become I wouldn't say a broadly adopted standard, but it is slowly becoming really the standard in a large amount of countries. It has been adopted, and it is already part today of tax reporting. In the GCC, Saudi is the first country, but Qatar has been thinking about it for quite some time and is expected to issue some legislation around this quite soon. And so is the case as well for the UAE. Now, the application of KSA e-invoicing is wide. It is all resident taxable persons, so it doesn't apply to non-residents. It applies to regular billing, also self-billing or outsourced billing, and to all invoices, credit notes, debit notes, and simplified invoices. So there's very little transactions and documents which are outside of the scope. What is out of the scope is imports of goods, reverse charge supplies, and also exempt supplies. Those do not have to meet the requirements of e-invoices. Now, phase 1 is relatively light in the sense that businesses need to use an electronic system to generate invoices. The only requirement or very substantial requirement is that a QR code is added only for simplified tax invoices. That means in tax invoices for a value lower than 1,000 reals. Those simplified invoices need to be printed for the customers as well. And if you agree with your customers that you provide a digital copy, then you do not have to print them. In addition, what needs to be added is an invoice title and the VAT number of the buyer as well, which is currently not a mandatory element. So you can see that is it in terms of the technical requirements. There's also a number of prohibited functionalities which are aimed at preventing that the invoices are tampered with. So these PDF invoices that will be sent need to have an XML element to it. Now in phase 2, as from 2023, the requirements, they become much more important. QR codes need to be on all invoices. The invoices need to be generated in XML, sent to the authority for approval. They need to have cryptographic stamps, unique identifiers, and importantly also your system needs to integrate with ZATCA, with the Saudi tax authorities. Now, a lot of our clients have been contacting us lately to understand what they can or need to do. And the difficulty is that there's not one solution for everyone. And therefore, I've decided just to put on this slide a number of criteria which might help you in selecting the appropriate software. Much will depend on what system, ERP system or accounting software you currently have, the size of your business, whether you have complex transactions or not, the sector that you're in, what finance processes there are, whether the software has interoperability. In other words, does it talk to other members of the same software? Do I have the possibility to automate my accounts payable process as well? What security and storage capabilities are there? And can I issue Arabic invoices, which is a requirement? And to what extent can I work in English as well with that software? Again, as said, I see a few people already in the Q&A. We will leave the Q&A for the end. Now, what I've tried to do here is list a few solutions here, ranging from simple bookkeeping software, which also produces compliant invoices, to developing software in-house, to getting a subscription with a software as a service, and managed services. So you see on your right-hand side that I've tried to use criteria such as cost, effort, and complexity. In regard to bookkeeping software that produces e-invoices, all of those should be relatively low. In contrast, if you're going to develop software yourself internally, then cost, effort, and complexity will likely be high. In regard to software as a service, it depends a bit on which kind of software. It could either be not costly to moderately costly. The effort of putting in data and whatnot can be burdensome. And the complexity depends a bit on the software. So there I put low to moderate. The fourth option is to have so-called managed services and outsource everything. So the cost would be moderate, the effort and the complexity would be low, given the fact that you'd be outsourcing this. Whatever option that you select as a Saudi business, you are going to be confronted with additional admin costs for this. This is guaranteed. Now, I put a bit of a comment in the bottom left in regard to the phased approach. Does the phased approach entail that perhaps we need to look at the fact that the first phase is a very light phase and take advantage of that and maybe give things a bit of time? And therefore, I used a plane metaphor, go into economy class first and maybe upgrade later to business. And that might be an approach that we've seen with a number of businesses, is to say, first, we're going to make sure that we meet the requirements for phase 1. And as for phase 2, we're going to wait a bit, because in addition to the fact that it will give us a year, we need to be invited by ZATCA to participate in the implementation, and it's going to go in waves. So therefore, a number of businesses are giving themselves a bit more time. Those conclude the first 2 points. Running a bit behind on schedule, and apologies for that. A few other relevant updates. This will not take me longer than 10 minutes. There was their first criminal tax evasion court case in the UAE, sorry, Supreme Court case. Supreme Court and the Court of Cassation are interchangeable terms. We were the first one to report about this case, and we've seen that a lot of our friends and colleagues in other firms have taken over the news without necessarily providing the context of this case. It regarded a case where the defendant was ordered to pay 4 million dirhams, which was 5 times the disputed tax amount. And the Court of Cassation works in a way that it will rule whether the Court of Appeal has rightly applied the law. And the taxpayer had lost in the Court of First Instance and in the Court of Appeal. Both of them had held that the taxpayer committed tax evasion. And the taxpayer had tried to claim in front of the Court of Cassation that the prior judgments, that the judges had misinterpreted and did not apply the law in the correct way. Now, the Supreme Court said the lower courts actually applied the law in the right way. They confirmed the conviction of the appellant and therefore ruled in favor of public prosecution. What the appellant had did, so the defendant, is say that the witnesses and the court experts had not taken into account the full facts of the case. And it is exactly there that the Court of Cassation has said the legal procedural principles have been applied. There was an expert designated, and there were witnesses heard. So therefore, there's no reason for me to cancel the Court of Appeal's judgment and send it back to the Court of Appeal. So those are very important nuances. And it also shows you the importance of or the over-reliance in the UAE court system of experts involved in the proceedings, rather than the judges making their own call. Quickly, a few more topics. ZATCA, so the Saudi Tax Authority, you might have seen in the last few months, has been incredibly active, publishing much more guidance, and a few days ago also published a guide which is currently only available in Arabic in regards to the deductibility of expenses. And there's something that we, at this point, there was some limited guidance only from the tax authority, and obviously there were courses provided by Saudi Organization of CPAs, but no official standpoint communicated by ZATCA. So this is the first time that on these principles they've made a statement. And the important thing is what the guide focuses on, because we see an incredible amount of activity in KSA on the side of the tax authority. And it's unsurprising that they focus on amounts which are paid between related companies, something that we currently see in a lot of the assessments and litigation as well, unfortunately. Interbank is maybe less relevant for the majority of yourselves. Employee expenses, always an area of focus, but then also bad debts as well, which has, due to COVID-19, taken a more important place in these processes. Two more things, and I'm almost done, is in regards to excise goods, there was a new decision implemented to apply the digital tax stamp system on more products. So you might remember that in 2019, the scope of excise tax was expanded. The TTS did not apply yet on these expanded scopes, where today we effectively had two colors for the DTS, i.e. red and green. Red applying for local markets and arrival terminals, arrival airport terminals, and green for departure terminals. As from the 1st of October, respectively the 1st of January, we will continue to be using red, but in addition, we will have also purple markings for e-cigarettes and water pipe tobacco. And as from the 1st of January, also blue DTS for the same category, but for departure terminals. There has been a bit of confusion around this implementation because the legislation that has been issued does not mention the purple and the blue DTS, and also says that the previously issued stamps are no longer valid. Now, after discussions with the FTA and with the producer of these DTS, they have confirmed to us orally that the old red and green DTS can remain there. They do not have to be replaced by new ones. But obviously for the e-cigarettes and an extended scope of excise tax, those products, they need to have those colors as from the respective 1st of October and 1st of January. Now, finally, before I give the floor to Q&A, the FTA has been on a, has lately become more open in regards to communication with the public. And so it issued a number of statistics which are relevant for the UAE. Those statistics are around registrations, home builder requests, and call center inquiries. And we've taken a few interesting ones. So cumulatively, the number of registrations in the UAE are 315,000, and we've got around 12,000 group registrations, which is maybe higher than what people would be expecting. There's not a lot of excise registrations. And the interesting thing that the FTA also communicates is that the number of registrations made through tax agents is only 571. So I'm not sure what this number represents. Is it a lack of trust in the tax agents, and therefore not a lot of registrations done through the tax agents? Or is it maybe a misrepresentation, and does it concern the number of tax agents? That is not completely clear. Now, what you can see is in regard to deregistrations, when you compare that to the 315,000 registrations in the last few years since 2017, there's only been 7,700 deregistrations. For those of you who have attempted to deregister a company, it is a very lengthy process, burdensome process that might explain why there's only very little deregistrations. But this is a number that we would have probably put at a higher point as well. I guess the conclusion from that means is once you're in, once you're registered, it does take a significant amount of time before you are deregistered. VAT group deregistration around 180, so it's not a very common event. Excise deregistrations 76. Okay, that concludes. As the QR code that you see in front of you is leads to my contact details. You can also see the contact details of our offices in front of you. I am going to open to Q&A as well, and I'm going to try and answer all of the questions live that you guys have put in the Q&A box, but feel free to add other questions as well. So Scott is asking, when do you anticipate full corporate income tax to be implemented in the UAE? So I think the first important date is 2023, because after the issuance of the legislation in 2022, in 2023, we will likely have either partially, so limited corporate income tax, or a full corporate income tax. If it is partially at the point in 2023, I do expect at some point that it will get expanded further, because it is very hard these days to make exceptions to corporate income tax regime without falling foul of the harmful tax regime test in BEPS action number 5. Someone is asking, would invoices through PDF format sent through emails be compliant starting from December 4th? So the invoices need to be generated through the system, but it doesn't say that you need to send them through the system. So our reply to this would indeed be that those would be compliant. In phase 1, would PDF format be sufficient to be considered as compliant? Yes, but it needs to be, it's a special type of PDF which has an XML aspect built into it. So those would be considered indeed as compliant. Iman, regarding implication of KSA invoicing regulations, do you foresee a possibility of increased charge of VAT by Saudi vendors due to the regulation, especially after the integration phase? Perhaps not necessarily an increased VAT rate, but let's say that the system makes the admin burden on businesses higher. So I do expect that we are going to see maybe businesses increasing their prices because of this, because it does have a bottom line effect. And obviously a lot of businesses are going to have to absorb the additional cost of the fact that they need to implement these e-invoicing regulations. And depending on the system that you choose to adopt, it can be costly or less costly. So that would be my expectation on this. What's your view on CIT on free zone companies? Very good and a very complicated political question. It is, I think, a question for the Ministry of Finance to answer at some point. There are certain options where you can continue to have a carve out, but maybe a stricter application of the free zone regime. Although in my personal view, again, in regard to BEPS action number 5, you might run into an issue there in regard to whether this regime is considered to be compliant or not. So it's definitely one of the questions that need to be answered in the whole implementation. The same thing was held true though for the introduction of VAT. Some of the free zone companies or the free zones considered that they would completely remain outside of VAT, which is not exactly the case in the end. So I expect that we will have a similar discussion on this point. Right, we have a few more minutes for any questions that you might have. Just as a reminder as well, we have recorded the session, and so we will be putting this on our YouTube channel, and we'll put a link as well on our LinkedIn page, and we will put a link in our newsletter as well for everyone that has missed maybe a part or wants to have another look at it as again. Raj Gopal is coming back to the topic of the free zones. Some of the agreements, they simply say tax, and they don't refer to income tax or consumption taxes or sales taxes. So, but it is true that some, in terms of the wording, some of them differ. So that might also add to the complexity of whether we will have the introduction of corporate income tax in the free zones as well. Any other questions before we close off? What's the status of the inter-GCC rules for Vats? These have been shelved for now. There's no news on when they will become operational, and indeed, if you look on the Saudi side, they're very busy with e-invoicing. the CIT plans might indeed see that the GCC is not necessarily very unhappy with the current system, even though it is sensitive to fraud. But there is no drive anymore to actually go and implement these rules anytime soon. Any other questions before we close off? I'll give it maybe one more minute, and then we will close the webinar. In any case, for those of you who have stayed back until the end and managed to attend the session, I'm sure that all of you are very busy. There's a lot of things going on. I hope you had an excellent summer as well, a refreshing summer to get ready for the last 4 months of the year. We'll be conducting another update webinar in a few months, as we've seen that this is a concept that a lot of people like. And do not hesitate to reach out if you want any clarifications on any of the topics, or if you have any questions for that matter and you want to engage with us. So thank you very much for attending, everyone, and wishing you a very good rest of your day, and hope to catch up with all of you very soon. Have a good day. Bye-bye.